Hello and welcome back to the Australian Stock Market Report. I'm Dale Gillham, the Chief Analyst here at Wealth Within. And as you heard last week, Janine and I are on holidays at the moment, so we're giving you a best of series here. Now, last week was the first one in our best of series where we're bringing you the best questions that you asked us during 2020. And as I mentioned, some of the questions you guys were asking, ladies and gentlemen, they were absolute crackers. So that's what we're putting on to the show. Plus, we've got some extra content for you that you haven't seen. Janine and I start today with our first 10 stocks. We're looking at the top 20 stocks on the Australian market by alphabetical order. So we're actually going to do a deep dive in the first 10 of those today. So we'll bring up each one, each chart singly at a time, talking about what we think about the stock, where it's been, and what we think it might do into 2021 to give you where you might find some great opportunities to profit in 2021. But first, let's get into some of those great questions. And the first question we have today is from David, who said, interested in what your thoughts are on how to handle shares that fall out of bed. Now, I understand you use stop losses and trailing stop losses and look for a change in trends, but if I don't check my holdings every day, things can change dramatically. Now, example is I have Appen. I'm still well in the green, but had a massive fall whilst I was away. Now I'm thinking I should continue to hold as it levels back out, but has now broken its short-term trend. Interesting question. I do get this a lot, especially in times when you're getting a little bit more heightened volatility. The first question is, or generally, if you've got a share falling out of bed on you and you don't, and it's unexpected, then either an event has happened or you've got the wrong share. It's pretty much as simple as that. And when you are in the wrong shares, and a lot of people pick more lower end stocks because they're cheaper, and you're going to get that happening quite regularly because the volumes through those are a lot lower, so they'll have bigger moves and bigger swings. If you understand trading, understand the market much, and you're buying great shares, then you're going to find that what's just happened or what's just happened to you with Appen is not really going to happen very, very much at all. It's very rare for you to have a share that just falls out of bed on you. It's rare for me to have that in my 25 plus years of trading. It's not often that I find a share just falls out of bed on me that I'm actually in. Normally I've had an exit signal beforehand and then it falls out of bed. But again, I'm not saying that's the case with Appen because it is a good share, but it's not one of the big shares on our marketplace. It's not in the top 50. But let's go and have a look at the charts to see what the stock is actually doing. So on your screen here is Appen. On the left, it is a monthly chart, and on the right is a weekly chart. And you can see how vertical it's been now. You probably remember I keep saying to you, or I have been saying for ages, the more vertical it goes, it's just before the fall. And again, we've had this big vertical rise through up into this level here in July last year. Then it fell heavily. And if I use my little tool here, you can see how heavily it fell. It fell 50% from July after rising so strongly. And if you see from that low to there, it rose 233%. Now let's go to this next one on the monthly chart. Here it's rose 178%. And since that high, it's now fallen over 25% to the close last Friday. So looking at it on the weekly chart, if we go over here, you can see it's been rising really, really strongly. Then we've got the big move here from Friday here. And I'll go down to the daily chart and we'll bring that up so you can see it a little bit more clearer here. So looking at that, there was a big gap down on this day. And this is what's actually happened to you from the close of that day to the close of this day. It was down 11, but at one stage it was down over 18%, and it's looking weak. Right now it's looking weak, but it wouldn't surprise me if it goes a little bit further. But that's exactly why you have stop losses, whether they're trailing stop losses. So the answer to the question is, you always have an exit strategy, whether it's what kind of stop loss, whether it's an initial stop loss or a trailing stop loss. So I guarantee you should be looking at those. Now, you're saying, I want to hang on to this, but how long do you want to hang on to it for? Do you have a line in the sand? So if it does fall further from where it is, what are you going to do? Or are you going to get more stressed that it's coming down? Now, you are in the positive territory, which you say, but how far? It's really, and to me, it's always about cut losses short, let profits run. And you're not in a loss at this point in time, you're still in profit. But again, you could be losing some of your profit because this could be falling down for another 4 more weeks. I don't know. At this point in time, I could do some more work on it. But right now, there's no reason, if I have a look at it, there's no reason why this thing wouldn't go back down to sort of $26 or even possibly below at this point in time from what I'm seeing. So just be careful with holding those stocks and don't just hold because it's falling away. Now, the first question that we do have today is from Shooting Star. He says, thanks, Dale.
could you please provide some advice on managed funds? He said, I don't feel I have enough time to trade and monitor. Now, interesting question. Occasionally I get questions on managed funds. I don't study managed funds themselves, like individual ones, and you've got a plethora of different managed funds, from index ones to growth ones to income ones to high growth ones. There are so many different funds, and that it's not possible for me to answer what you should be doing there in terms of managed funds, in terms of what ones you should be buying or what you should be looking at. I don't know how old you are, all those sorts of things. And that's really where you need to, if you are set on getting into some managed funds and using those for your investing, I would suggest a couple of things. One is go and find a financial advisor first, so that you can work out based on your stage of living what you should be doing. You can get limited advice and things like that, so it doesn't have to be costly for you. The second thing is I'd make sure I'm saving money. The first thing is you need to do is put some money away and just keep saving money and keep putting that into your investments. That's the second thing that you need to do. Also, sorry, that should be the first thing. The second thing is then go and see an advisor and work out what you want to do. Another part of that question is it's often a false belief that people don't think they have enough money, enough time or enough money and enough knowledge to actually have a good stock portfolio or share portfolio. All you need to do is get my book, How to Beat the Managed Funds by 20%. It's your money, it's your choice. You can get it for free. I mean, this is the copy of the book. Here it is here. Get online, get onto our website. It's free. All you got to do is pay for the postage. So what better opportunity can you get? Free book. Pay the postage. And here we talk about, or I talk about, the top 20 stocks on the Australian market, how you can buy them and be very, very passive with them. And following these things, what I've got in this book, maybe 1 hour a month is all you're going to need to buy and hold some of those top 20 stocks and not do too much. You don't need to be Einstein. You don't need to have a maths degree. You don't need to have a lot of time. You don't need to have a lot of energy in it. You don't even need to have a lot of money to get in. I share with you how to do that, and I think, to me, that's a far better way. You'll make far more money. You'll have a lot more control over your money. Now, I could also suggest you go to like an index ETF, but again, following the rules in that book, you'll beat index ETFs every single year. It's just hands down, it will happen, because managed funds or index ETFs track a market. What we talked about in that book is to beat the market, but not increase risk. And so, as I said, just get the book. As I said, it's free, just pay the postage. But good question. And it's just a little bit of knowledge, a little bit of time, and as I said, maybe 1 hour a month is more than enough.
All right, hope you've enjoyed those questions and my answers to those questions. And again, I keep saying to people, send your questions in. I mean, you might be sitting there thinking, I've got this question, but I'm afraid to ask. And they're the questions we really do want to hear. Janine and I are really happy to answer all your different questions as best we possibly can, so that you learn more and you understand the market better. Because to me, the more you get into the market, the more you understand it, the more you profit, the more Australia grows, the more everybody benefits. So it works for everybody. So please don't just sit back and watch. Participate and put your questions down on the comment section below. But we need to get into our section now that Janine and I recorded only just a couple of days ago. But you're now, what we're going to show you is those top 10 stocks, or the first of those top 20 stocks, the first 10 of those top 20 stocks, if I can get my mouth to work. But let's get into that now. Well, last week we actually went through the sectors on the Australian market and gave you our thoughts on where we thought they'd be going and where the opportunities might lie into 2021. So today we're going to go through the top 10 stocks, or 10 of the top 20 stocks, by alphabetical order, and next week we'll do the second 10. So, hey Janine, I'm looking forward to doing this one.
I've been waiting for this all year. Sometimes, I'm not allowed to do these things until we get to the end of the year.
But everybody watching's been waiting all year for us to do them. So you've got to wait for the last show of the year. So hopefully everybody had a great Christmas and enjoyed themselves and didn't eat too much. But and you've got your New Year's Eve celebrations all organised. So.
Well, look, I'm excited about the stocks, I can tell you that. So you excited about this?
Well, I'm excited about New Year's Eve and the stocks.
Should we just get into it?
So let's start on the stocks. So the first stock we've got, as I said, by alphabetical order, Aristocrat Leisure, number 1.
All right. Now, this is doing something that I was hoping it would do, because I think Aristocrat went up, but it was almost like it didn't want to go up. A few times it had false starts along the way. And it's now pulled back quite strongly. So what we need to, I'd like to actually see it go down for another month. If this stock goes down for another month and then starts to move back up, we could see some really good opportunities trade this in 2021. So, and then it could crack the all-time high. That's what I'd be watching.
Well, yeah, I think you're right. I mean, this stock is quite a big mover when it does actually move. You can see it's very, very volatile, but had a big move through here. And this is what a lot of people don't probably necessarily appreciate, that stocks will go hard and then they'll ease off a little bit, and that's really all this is doing at the moment. It's run pretty hard through here, more so than other stocks.
I guess over the years that we've started to appreciate the fact that half the time you can look at a stock, and if you miss it, you're not going to miss it too long, because 9 times out of 10 it'll pull back 10 or 15% from the high, and it'll wipe out what it's just recently done, and then you can get an opportunity to get into it.
I've been watching a couple of stocks do that more recently. So, but Aristocrat Leisure, not yet, but probably you're saying into the second quarter of 2021 might be a good opportunity.
Look, I think even potentially in the first quarter, 2021, but we're going to go through reporting season, obviously.
Yes.
And with reporting season, stocks are going to be beaten quite hard if they're not performing, if they're coming in under analyst expectations. To me, there's a little bit of risk with this one. So
a little bit of risk. Now, one of your favourite stocks at the moment, ANZ, I know that.
Yeah, look, ANZ I really like. I think that the company's just weathered the storm better than the other banks in terms of the negativity around banks. And I think that could, because ANZ's made a lot of mistakes too over the years. It's not, it's not just NAB and Westpac and Commonwealth Bank, and I'm not talking about just what's happened with the anti-money laundering stuff in the Royal Commission. There is a whole history there if you read up on ANZ and what they've done over time. But look, they have got the potential to be the stronger bank if they, are able to find support around that $21, $22 mark.
Come back
hopefully, around there. Maybe even $22. It might not come back as hard as the other banks, I think, or get sold off as hard. So people who are short selling, you wouldn't want to be trying to short stocks like ANZ and potentially NAB right now, because I also like NAB. It's been at the bottom of my list for a long time.
We'll get to that, when we get into the end, you'll be able to talk about that one. Why not?
Okay, I'm ready to talk about that already.
Before, but you are right. I mean, since we're looking at this since September, it's just had a spectacular rise.
And it looks like medium to long term it could be up. I'd expect it to continue to head up towards that $26, $27 mark over time.
But it has been a frustrating stock, I know, for a lot of people who buy and hold.
Look at the chart on the monthly chart. It's been a mess.
Yeah, I mean, all the big four banks had their all-time highs March, April 2015, so they've had big long moves down. This is more volatile than generally your Westpac.
And there was still a risk on the downside. When it was tracking around that $20 mark, $19.20, it was still a risk that it could have just turned and gone back down the other way and kept falling just because of the overall pattern, long-term pattern on the stock. But the recent rise has sort of mitigated that to a degree. It doesn't eliminate it 100%. But the risk is reduced while it's up around these levels. Okay, so a few weeks down and then possibly get some support, then start to move up. That's the ideal scenario. That's the ideal. Another one of your favourite stocks is BHP. BHP, and it's moved on. It's actually galloped ahead in the last couple of weeks, but we can see a gap there on the weekly chart. It's moved ahead really strongly. I think that it could come back. It's actually done the opposite. I expected it to pull back further in that decline where you've just drawn your level from that low to fill the previous gap. It didn't do it. So, and there's even a gap after that low. It hasn't filled that. And because of what's going on with iron ore at the moment in China, I think there's a lot of speculation. And I think people, have been switching money from one commodity to another, or they're moving sectors. So we've seen this shift from the information technology sector, a little bit of money going into financial, a little bit of money going into energy, and then back into these stocks again. So, it's just that rotation that we're seeing at the moment. You were going to say? Well, I was just going to say, with China, they need our iron ore. It's not as if if they put tariffs up and everything on it, they're cutting their own throat a little bit. Well, they want to stimulate their own growth, don't they? And they need to use construction to do that. That's just a standard formula for any government to put money into infrastructure, isn't it? Yeah, it is. It is. And whilst they put tariffs and everything on our other commodities, being food, basically, food and wine is pretty much what they've done, and they've made. You would think that their population would be suffering some degree because obviously they're paying more for this, or they've got to get it somewhere else, possibly at a higher price. Well, the price is really high right now, so that's going to be hurting them. So, they've probably been preparing all along and buying the iron ore when it was really cheap and stocking up on it. So I think that if they're in a really good position, and nobody knows exactly how much they've got stockpiled, So if they're in a really good position, they could just slow things down at any point, I think.
They could, and that's what part of what my question was, is do you see in the next 12 months that China's going to escalate this, put tariffs on it, or stop buying iron ore from Australia?
My word is I don't think they'll stop completely, but I think that they may decide to slow down what they're importing.
Because I know at the moment they're buying more iron ore than they were before
previously.
pre-COVID. So they've actually stepped it up, not the other way. So it'd be interesting to see how it pans out.
Yeah, so if people are buying gold, they're buying commodities, all of these tangible assets, it's sort of like that wartime situation where you stock up on all the things that have that sort of intrinsic value. So that's BHP, and it looks quite nice.
So you wouldn't be
this is
too
always
worried
a
about
stock
it.
to have on your watch list,
Okay.
really.
Cool. All right. So let's move on to another one, which is not necessarily one of your favourites, but it's still one you do like. It's Brambles. It's a lot more volatile.
Look, it has been over time because it's a really good stock to trade short term, short to medium term, but not one that I like for long term. Just because of the volatility, as you've just identified before, because it can just turn on a dime. It can have really nice runs at times, but you don't know which wave it's trading on at the moment. And then looking at this, it's just a complete mess in the last few years. So it's not one of my favourite stocks at the moment, right? But it could be better if it actually trades back above that 1180, around that level. 1160, 1180.
Mess here, it's sort of really, if we can get some free sky, so to speak, or fresh air, so to speak, that's what you're saying, yeah?
Yeah, so it might actually do something over the coming months. I just don't. Coming into reporting season, you just never know what the outcome's going to be for these types of companies.
Yeah, and then that's okay. I mean, obviously, with the world in sort of shutdown as well. I mean, Brambles with the Sheps pallet, that sort of stuff, it's probably been hit there. So we do really need to start seeing.
It's all going to depend on the forecast, isn't it?
Correct. It's really going to depend on that. So this is probably why we're seeing a little bit of. It hasn't been that strong over the last few months anyway. So, but it does remain to be seen. But there's possible opportunity there, if we get the right figures coming out.
Yeah, look, if it keeps falling and it goes back below $10.20, $10.20, I'd be really concerned about the downside.
Yep.
But I'd still have it on a long-term watch list because, if it did fall through that low, then it just sets up for the next opportunity.
The next big run. And this thing can move pretty quickly. As you can see, this move from the March low of $8.97 or $9 all the way through to $12. It's a 30% move in a few weeks.
But at the moment, more likely to go up short-term, I think, once it's had this short-term low.
All right, another one of your favourite stocks, Cba Bank.
Yeah, Commonwealth Bank's done incredibly well. Although, when we're looking at banks, we didn't vote this as the top of our list, on our watch list, even though we normally do, just because of the long-term shape of Commonwealth Bank. The COVID pullback really confused it.
Yeah, all this it just didn't look good, did it?
Well, it's just totally blown the actual pattern. We talk about price, pattern and time have to be aligned to be purchasing things. Well, we couldn't tick the box on the pattern, could we?
No.
It was so confusing. So, that was the reason for this one, but it's gone in its previous historical fashion. It's actually gone ahead and defied all of that. So quite amazing for Commonwealth Bank, although I think it's overdone right now. I think that the target for this stock is sort of between that $80 and $82, and it's traded through that. So I think this is getting the sort of a wave, really, of that buying.
Yeah, I agree with you. It's probably gone a little bit too overheated, but banks are a different beast now than they were pre-GFC. Really, they've diversified their wealth management divisions, they've restructured their business, they've had a lot of different regulatory changes, a whole range of stuff, and so can I say that they've been doing that the last 5 or 6 years?
Well, you'd think they'd be leaner, wouldn't you?
And you think they'd be leaner. And so maybe that's when they are doing well, it's going to hit their bottom line a bit quicker and they make more profits, and they are going to be a little bit better.
Well, we've seen foreign banks come in, and during that whole upheaval, foreign banks came in and took a lot of customers away.
Absolutely. But right now it does look good, but as I said, I agree with you. I think it's probably a little bit overheated with this big move through in November, so wouldn't surprise me if it comes back a little bit into January. Probably, I was about to say the deeper the fall, the better at this point in time.
Look, I just think, I don't want to talk it down too much because it's been so strong. I just think that it'd be nice if these banks just do what we expect in normal formation. Yeah. And then we see the pullback over 2 or 3 weeks maybe.
Yeah, 2 or 3 weeks.
And then we see, a bit of a steadying and then a push back up again. That would be, ideal.
So maybe February, March next year?
Look, it could be sooner. It just depends on what happens in January.
I'm trying to get people a hot tip. That's what I'm trying
to do.
Well,
would you put your money in it now?
Yeah.
Okay.
No. Yes, no. I'm trying to ask the questions that they're going to be asking in their while they're watching us. They're going to go, Dale, should I buy this or not? And right now, no. Wait for it to come back a little bit and then come back into later. That's the answer. Coles Group, have a look at this. It's obviously, it's just a steady performer, isn't it? Really just a steady performer.
And look, as we said, the pattern that it's forming at the moment, though, the way that it's unfolded over the last sort of 3 or 4 months, it looked more like it was going to go to the downside. So I was expecting it could head down to between $16 and $17. It may not do. It may just keep tracking up along that angle. So if it does go through the all-time high, we could see it go higher still into 2021.
It is interesting how this has performed post-COVID. It really,
isn't it?
There's your COVID low and this thing just blew it out of the water.
The sad fact is that it probably would have helped the Wesfarmers share price in reality if they held a position in it.
Correct.
I don't know what equity they continue to hold in it at the moment.
No, I haven't actually looked at what they're actually doing, but you would have helped Wesfarmers do much better during the whole COVID thing, but right now it still looks all right. It's possible it could keep rising through and keep going at this point in time, couldn't it? It's a very nice looking stock at this point in time. So now CSL is one we talked a bit about last week because of the healthcare sector. It's going sideways and downlish a bit at the moment.
Yeah, as we looked at, as you rightly said, with the sector, the expectation is that we'll see potentially another week down and then a push back up, and that'll be the real test for CSL, but it really needs to get through around that 310, 320 mark and then start pushing higher. The risk is to the downside, but that doesn't mean it's not going to recover because this stock has done amazing things. Look, when we thought it was going to be pulling back in a pattern formation, it actually defied all that, kept going higher. So it could just track that longer term upside angle over time anyway. In healthcare, we're not expecting it to be a huge stellar performer in 2021, but we are expecting it to be up.
We are, correct. We are expecting it to be up. And just a reminder to everybody, we are recording this, you can see down the bottom, on the 15th of December. So by the time you're watching this, it'll be like the 29th or 30th of December, I think, or maybe even into 2021 by the time you actually get over your hangover and start watching. But so just be mindful that is not the last bar on the chart from where you should be seeing. So you'll know a little bit more about what's happening at this point in time. But now let's go into one that's done an absolute stellar performance this year, FMG, Fortescue Metals. It doesn't get much better than that, does it?
I mean, that's just done incredibly well. It's just gone straight out of the blocks again. But that's a whole sector-wide move that we've just seen recently. Again, with BHP and Rio and this stock, the expectation is that short term we'll see a bit of a sell-off into January. So keep watching for that.
Yeah, so you're expecting it to come down through here into January because that's a stellar rise, isn't it? If you look at that.
Yeah, look, I think it's traded. It's done almost double what the all-time high was at the GFC. And often when stocks make those sort of moves, you do see a pullback from those levels.
Yeah, so you've got that. So there's your GFC high. So if you're saying from that point there, that's the GFC high. So
26 would be about double, but it's getting pretty close now.
It's getting pretty close. So you would think it would start to fall back in. And again, I think you said it to me in the past that if you're looking at any one of these BHP, Rio and Fortescue, you wouldn't be picking Fortescue moving forward into next year.
Would you pick them first?
No, because again, I'm agreeing with you. I think their momentum will slow down because eventually they just get overbought and they get just too expensive in terms of what the real value is. And I think you're right. There's probably more value in BHP.
Yeah, look, it could go up into January, but the ideal scenario is that we see that follow the overall trajectory come back to the angle of the trend. Yeah,
so you're talking about if I put just my cool little trendy line type thing on it, you're just saying coming back to its normal sort of momentum-ish back down to those sort of areas.
Yeah, that's right.
Okay, cool. All right, there you go, everybody. So if you're in Fortescue, just make sure that you're looking out for yourself in case it does fall away. Another stock that's done reasonably well is Goodman Group. I mean, have a look at that since the COVID low.
Yeah, the property stocks, that shocked the investment team. We've had a bit of a sceptical view on the property side of things, but it's actually defied
everything.
Everything that we thought of, and the whole property market, maintained, and it went against all of the residential real estate experts thought the whole market was going to crash.
And it didn't.
And now we're starting to see that sell-off happening in the property side after a run-up. So a lot of the stocks in the property sector actually haven't performed that well. It's been Stockland and GMG that have done really well. Yep. Stocks like Dexus, MGR has done okay, Mirvac.
Centre groups sort of.
Yeah, but look, it's done okay. This one has done exceptionally well, and it does tend to perform better over time. So Stockland, at times, we've really liked that stock, and we've had some good trades out of it. And we just chose to take the, a bit more wait for certainty. So wait for that pullback on the Stockland group, and then we think that more medium to long-term opportunities will come out of that. It's about being patient. And this one, I still think that there's more opportunity there with GMG. We've just got to wait for this bit of a flush out.
Well, you've got to think, with the government it depends on what's going to happen with more stimulus moving forward. Now, whilst we are technically out of a recession, having a quarter positive GDP, the figures that we get out of the first quarter next year will be really important, or this last quarter of 2020, and then the first quarter next year will be really important about retail figures and other different figures to see whether we stay out of the recession that we had with the COVID.
But look, I think we're always chasing our tail by trying to follow that sort of data, because that's one thing that I learnt in the COVID pullback, because we were still looking at the market at that point, right? Just say that's the point where the market actually started to confirm it was going up. And a lot of these sectors or stocks then became close to their highs. So then it precludes an entry. Then you've just got to wait for them to go through those highs, and then you've got to decide if they've got enough upside. And you can see with GMG that by the time the market actually confirmed that it was actually going to rise, with GMG it was too close to that high. It then went on, and now it's going to wipe out all of what it made anyway. So that's why you wouldn't have got into that at that point. You see, so learning from that, if you're focused, if we as traders, investors and everything else, if we're paying too much attention to that information, it can then cause us to get caught out rather than,
So you're saying
pure.
watch the chart first.
I think technicals will rule this year. That's the economic data.
You heard it first on our show. Technicals will rule this year.
The economic data will just be, catching up to whatever has happened. Either stocks have been overtraded and they've gone too fast, or we're going to see stocks that have really lagged and there's uncertainty around with the data. Those stocks could then just start to move higher.
Awesome. So the last stock for today's recording, that's our Insurance Australia group. Now, doesn't that look like it's a bit better?
We both look like this. We do, it's improved quite a lot. We've seen this actually just come off. There's been some negativity, negative news around IAG, that's why the stock actually, it shot up and then pulled back really quickly a few weeks ago. So we need to just see all of that settle out, and then a bit more confirmation that it's going to keep going up.
Normally insurance stocks is ones we generally don't like too much.
Well, no, look, the investment committee it's a bit of a dirty word when you start talking about insurance companies because of the risk. It's all about the risk and looking. It doesn't matter whether the stock ends up rising after the fact. It's about the risk that you're taking at the time if you are choosing to take it.
But it is looking a little bit better now. We've had several weeks onto the upside, so it looks like it's starting to find some support, although I think I'd be really comfortable once it sort of gets through this 560 level area and thinking, well, it's probably going to be a lot better from that.
Yeah, but you just never look a gift horse in the mouth with this sort of thing, because it can turn around and bite you.
Okay, so make sure you've got a tight stop loss on. Is that what you're telling everybody?
Yeah, tight, but not too tight.
Okay. So out of the top 10, what would you be your picks, just if we pick three? Which would be your
out of
top
these
picks?
stocks, obviously I like ANZ this year. I think that's going to be a good stock opportunity. BHP, but all of these stocks I'm just saying not right now, but when they come back a bit and they move on into 2021. I think those two, I think Commonwealth Bank, if it actually proves it can get through that 82 mark, so we need a pullback and we need a confirmation of a move back up. I really like coal, like coal's from a long-term trending, just a plotter. It's just to underpin a portfolio, but again, we're still waiting for the right opportunity there. IAG I like.
I only asked for three, now you're up to five, aren't
I've got five, but I always give him more than what he asked for. Isn't that what we're supposed to do?
I keep saying you're a personal trainer in your old life, because they can't count either. But anyway, that's our take on the top 20 stocks, or our first part of those top 20 stocks, so the first 10 in alphabetical order. So stay tuned next week for the second 10. Have a great night on New Year's Eve. Stay safe, and we'll see you back here next week.
Bye for now.
All right, I hope you did enjoy those first 10 stocks out of the top 20 stocks that Janine and I talked about. And there's probably a couple there of interest that you've probably written down on your pad going, I need to look at this one over the next coming months. It's almost New Year's Eve, so I'm sure you're excited about getting out there and having a bit of fun for New Year's Eve and kissing goodbye to 2020, which has been so challenging to all of us there in multiple different ways. And I do hope you've have a safe New Year's Eve, and most importantly, start setting down your goals for 2021, because you really do need to design your life. And there's always that saying, if you fail to plan, you plan to fail. So now's a perfect time to sit down, set down those New Year's resolutions, put a little bit of action behind them, and anything is possible in 2021. So I'll see you in the new year with our next version, or the next 10 stocks of the top 20, or Janine and I's takes on that. But for now, goodbye, good luck, and good trading.